Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, August 10, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And I don't know if I really need to explain much of what happened today. I think everybody by now is aware of what happened today. The market got taken out behind the woodshed and shot 3 times. And I would say that the top is in. The top from 2 days ago where we identified the tail candle, the intraday reversal, created a tail candle. I said you can go short against the high of that day on daily close. And today we had the thrashing on the downside. The downside's not done. But remember, and I want to emphasize this because it's very important, you're going to see large swings in both directions. It's going to look like everything's fine at times, and at times you're going to have days like this and potentially worse. Today was day 1 of what should be a real bona fide correction, which we haven't seen in quite some time. And when I say that, I'm not talking about this stuff here where the market pulls back for a couple of days and we pull back for a couple of days in a bullish formation. That's not what I'm talking about. What I'm talking about is an actual correction which we haven't seen in quite some time. Now, if I roll back the clock, this is June of 2016. We see a correction of about 100 S&P points. Here's 212. Here is 198. So, it's more than that. It's 140 S&P points in that neighborhood. But when you look back even farther, this is the type of correction that I don't know that we'll get, exactly this. All I know is that I'm looking for something bigger than a bread box. So we were up here in November of 2015. The high was 211. By January of 2016, we were at a low of 181. Okay, so that's more in line of the type of correction I'm looking for. I'm looking for something in their neighborhood of around 10 to 15% in that realm. It could be even more, but I don't think it'll be less than 10. Again, it's going to take some time, and it's not going to be down every single day. That's not the way the market works. Now remember, the market is a lot higher than it was before, and I don't mean to be Captain Obvious, but a 10% correction is going to be, if we should get one of those, around 250, give or take, S&P handles. That's $25 in the SPDR. We made a high of about $249 the other day. Just to put that in perspective for a minute, that's down here. Okay, a 10% correction from the high the other day is all the way down around $224, give or take. So there's a long way to go if I'm right, and that's what we're going to see over the next couple of months. It's not 100%, nothing's 100%. All I know is the correction started, at least from my perspective, we see a character change in the market. A day like today is definitely a shot across the bow. It's unlikely it's a one-shot wonder. What's interesting is, and those of you that have been around for a while know that I've been talking about this time frame for quite some time. It's been a few months now that we've been talking about mid-July through the first week or two of August. We'll call it mid-August. Well, here we are at the 10th of August, and we see a pretty decent down day to the likes we haven't seen in a while. But what's fascinating to me, and it's always fascinating, is that it coincides with a major news event. It coincides with the saber rattling that's going on right now with North Korea. Now, who knows what's going to happen, if anything, with North Korea? That's not really new news. It's not a new issue. We've had these issues with North Korea for years and years and years, going back to the Clinton administration in recent times, but all the way back to the Korean War when we came to the defense of South Korea, which is why we have troops there today. So the point is that it just so happens that over the last couple of days, that news is in the forefront. The leader over there is threatening to launch some missiles near Guam or at Guam, and all of a sudden President Trump is, telling the world that we're not going to stand for this kind of nonsense, and everything changes. And it's interesting, more so fascinating, how it coincides with a major cycle time frame for the markets. And if you've been with me for a long time, and a lot of you have, I know you've seen this before. We've read this book before. This is not our first rodeo. It happens over and over and over again. Not all cycles work 100% of the time. But what's interesting is we can tell the cycle is coming based on the charts, and it always seems to coincide with a major news event. And that's why it's very difficult for a lot of people that don't understand cycle work to wrap their head around how this really works. And they'll fight you on it and say, well, the reason the market's down is because of the news in North Korea. It's pretty obvious. And I get that. And that was the spark that really sent the market down. But we've been talking about this cycle topping out for months. And we haven't been talking about North Korea in the magnitude it's been talked about over the last 24, 48 hours. We haven't been talking about that for months. So it's quite interesting, certainly on and off, but not anything that's, same as it was over the last day or so. So it is fascinating, and those that don't understand it tend not to believe it because it's too easy to believe that the reason the market's down is because of North Korea. It sounds obvious. It sounds reasonable. They're talking about it on TV. Therefore, it has to be right. I'll just take another little side soapbox and we'll get back to the markets. The other side soapbox is when they talk about the economy and the market. You see, when the market goes down, it's going down, and I'm talking about in reference to the media, for example. The market's going down because of North Korea, okay? And then they start talking about, well, the market's a little overextended, and therefore we're due for a slight correction, and it's normal, it's no big deal. And that's what happens. And then what happens after that is they start talking about, well, the economy's fine, so the market should be fine long term. The second half of the year is going to be fine. This is just, a potential correction coming, a garden variety correction. We have them all the time. And that's what the media will say. And it's not just the media, but it's all the industry experts, quote unquote, or I should say air quotes, experts, that they parade on TV that have these conversations, and they say the economy is fine, the economy is strong, the Fed says the economy is strong, all that stuff. But what happens is, and again, you guys that have been around a long time know this, they have it 100% backwards. It's not the economy that drives the market. It's actually 100% the other way around. It's the market that drives the economy. Now, if you haven't heard me say this before, go with me on this. I'm going to spend a couple of minutes. If you have heard me say it before, bear with me. So what happens is the market is going higher, and therefore the economy is good and everything is good, and a rising tide lifts all boats. That's fine. But when the market goes down, remember, it's never the economy that goes down first. It's not the economy that goes into recession first. It's not the economy that shows signs of weakness first, and then the market follows. You're very hard-pressed to find a time when that occurred in that sequence. What happens first is the market goes down, and then they start talking about the economy's getting weak. And then they start talking about a recession, and then it becomes a self-fulfilling prophecy, and one feeds off the other, and they both go down together. But it's actually the market that sends the economy down. It's the market that shows signs of weakness first, and the economy follows. And you can go back in time, and if you want to take the time and go through the detail of when the economy was being discussed at such a high level, and when the market cracked first, or if you can find a vice versa, go ahead. But you're going to be hard-pressed to find a time when the economy weakened and then the market went down. It's actually the other way around. So as the market goes down, if it should continue down, you will hear discussions about the economy weakening. Earnings are weakening. They're not as good as expected. They were fine a week or two ago. Everything was great a week or two ago. You didn't hear a peep about anything negative about earnings or anything. And what we've been discussing here is that the breadth of the market was terrible. There was very few stocks on the NASDAQ and the Dow that were sending the indexes higher. In fact, I talked about it, I think, a week ago, that there were really 3 stocks that sent the Dow higher, most of the percentage since the election: Boeing, McDonald's, and Apple. If you take away those 3 stocks, and I don't know the math on this, I didn't do the numbers, but I think that the market is actually close to the flat line if you take out those 3 stocks. That means that the remaining 27 stocks in the Dow are not helping the market on the upside. Therefore, the breadth of the market is horrible. And we know the NASDAQ story. The NASDAQ's been going up on, anywhere between 5 and 10 stocks. Outside of that, when you look at the individual names, it's not that great. We've been talking about it here for a while. Now they're going to start to catch on in the media. They're always a day late and a dollar short. And why is that? By the way, because the media is a business, okay? The media is in the business, and when I say the media, I'm talking about CNBC, Bloomberg, Fox Business, all that stuff. They're in the business of selling advertising. It's very hard to get an objective opinion. They don't want to hear negative news. They don't want to hear bearish news, especially as the market's rising. They just want to hear everything's great because, truth be told, when the market goes down, people tune it out. They don't want to see it. They don't want to watch their 401ks go down. They don't want to watch their account values go down. They don't want to watch their stocks go down, whatever it is. So therefore, if I'm not watching it, it's not happening. So I turn it off. I turn the channel. And if you turn the channel, that's less viewership. Less viewership equals less ad dollars, ad revenue. And that's just the way it works. So you have to realize that it's a business like anything else. They're in the business of being bullish. So check out the IWM today. And by the way, let me go back to the spider. I jumped ahead because I got on 9 different soapboxes, and I apologize. Obviously, you already know because you see the time, but this is obviously going to be a longer video tonight. But, it is what it is. It's that time to do a longer video when things like this happen. So where is the downside, at least in the near term, where we should be expecting some kind of support on a temporary basis for the spider? Well, really the first area that we need to be concerned with, and by the way, we no longer need the 245.40, but there is something I want to show you real quick. Here's a 60-minute chart, and it just so happens that on the 60-minute chart, as a coincidence, today crossed over the 245.40 level. I couldn't see it and I forgot the number. 245.40. On the 60-minute chart, the 200 period moving average crosses over that number spot on today. We pierce through it, okay, and rally back slightly, right? We had a paltry rally at that, but we did bounce off that level today, and then they gave up the ghost. But you can see even over here this afternoon, right around lunchtime, the market made a high of 245.43. So that number was important any way you want to look at it, and that's why it's been on the chart for this long. But now it's done. It's over. We don't need it any longer. The next number we're concerned with is basically, from a mathematical standpoint, $240.43. We can really just call it 240, right? And it's pretty obvious. There's a number of reasons why this number is important. Here's a pivot here. That's important. And even when you go over to, let me get rid of that line. I can't go to the weekly chart with that line on. When I go over to the weekly chart, you can see the importance of that pivot. We rallied up to that point, give or take a few pennies, right? But who's going to split hairs over a few pennies? It rallied up to that point and was rejected. We had a pullback, and this is on a weekly chart. So we had a pullback for about 8 or 9 weeks before we went higher again. So we rallied up there, pulled back for a couple of months, and then rallied again. So that's an important level, and we're going to come back to retest that level, in my opinion, anyway. So it's right around $240. That pivot high comes in at 240.32, and there's another reason why that number's important. It's actually a midpoint, a 50% level in between the top that we put in the other day and the 25% retracement. That 25% retracement comes in right around 232. I didn't put it to the penny. It's a couple of pennies off. I rounded it to 232. It's right underneath today the 200 period moving average that is upsloping. But if the market should continue to come down, this line should begin to flatten out. So anyway, and that brings up another point. Watch this. If you look at a weekly chart, okay, and you say, well, here are the lows from January and February of 2016. All right, the market's basically been, from a longer term perspective, on a straight line up. At what point do we have at least a 25% correction, also potentially a 382 correction of that move? I mean, when's the last time we didn't correct an up move? It's never happened, obviously. We will correct this move. It's just a matter from what price. And as far as we can tell today on the daily chart, and tomorrow's weekly close will tell us even more information, but as far as we can tell on the daily chart, the top should be in. It would be very unusual if we made new highs from this point forward without correcting this market, okay? So the first level down is 240.43, and the next level is in the 232 neighborhood. There'll obviously be more in between. You have pivot low here that'll be important to the market. That's at 235 and change. That's also very important level to the market. It's a nice even number, round number, 235. You have 240. So these numbers will be important to the market, but we'll talk more about them as time goes on. Let me move along to the IWM. The IWM came right into the 200 period moving average. I don't have to spend too much time in the IWM. Why? A, it was down 2%. It was leading the markets lower. The spider was down 1.5% on basically 118, almost 119, 120 million shares, we'll call it. And that was a pretty decent day in consideration of the fact that we've had no volume of late. Today we had volume. The IWM, 42 million shares against an average daily volume of 24 million shares. This is a bona fide down day. We had institutional participation on the downside. And that's why the volume picked up, and that's what it takes. It takes decent volume to drive the market lower to the likes we haven't seen in quite some time. We found support at the 200 period moving average, no wonder, but that's a pretty decent down day, almost $3 down in the IWM, but this was giving us the signal. We've been talking about it for a long time. We had the down move, we had sideways little shimmy for a few days, another down move, and here we are, and everybody's looking like a deer in the headlights, wondering what happened. We've been talking about the fact that our two favorite leading indicators were the canary in the coal mines, telling us that downside was coming. It was just a matter of when. And by the way, there's a lot of chart support in this neighborhood here in the IWM. So eventually we're going to see it bounce in the market, right? So we may have a little bit lower to go. We have some pivot lows down here, pivot. So that comes down at about, let's see where these pivots are. These pivots are right around we'll call it 134 to 135. So we may have some more downside, for example, tomorrow or Monday or both, but we should find some short-term support in this market pretty soon. It's not going to cut through all these pivots like a hot knife through butter. We had the 138.74. That was important. Last night, they rallied the market back to close a few pennies above that, and then they hit them hard today. The market, they never make it easy. The market does not make it easy on both the long and the short side. It always does the thing first. It always does first the thing that it's not going to do. It always looks like it's going to do something different, and then it ends up doing the thing it's ultimately going to do, which was to go down. We saw it coming, but it's not. That doesn't mean it's easy to trade. The transports, same thing. We've been talking about this bearish pattern ever since we started selling off when the other markets were going higher. That was a canary in the coal mine. We shimmied sideways, and when we had this big down day, that was the real shot across the bow. We've been going sideways, and I said as long as we remained inside the high of this red candle, this market's going lower. And it wasn't going to be supportive by the 200 period moving average. And as you can see today, we're below the 200 period moving average. We already hit it once, and we've been consolidating for a couple of weeks above the 200 period moving average. That diminishes the importance of the 200 period moving average. I probably said that 3 or 4 times over the last few days, and here we are below the 200 period moving average on a hefty down day, 115 points in the downside, 1.25% on the transports. So everything's playing out pretty much like we mapped it out. Here are the Qs, the NASDAQ. You had the down move, sideways. Here's another down move. We closed below the 50 period moving average, and there's a gap down here. So they're going to likely go for the 139 area. The actual gap number comes in at 139.05. They're going to go for the 139, maybe spike it down to 138, but that's where they're going for. That's another $3 in the Qs. That's another big move. That's another 2% move in the Qs. It's another big down day. Doesn't have to happen in one day, but that's where we are. Another $3 down in the Qs before we find short-term support at that gap fill area. XBD, we've been talking about the fact that without the financials participation, the market doesn't go down, and without the financial participation, the market doesn't go up. It's unlikely both those scenarios ever take place. From time to time, there are anomalies, of course, but in the larger picture, the market goes down, the financials are going with it. The market goes up, it's not going up without the financials. That's just the way it works. Right here, you have the 50 period moving average upsloping into price. This price could provide some temporary support for the market, but we'll see. We'll see if we get another big sell day tomorrow. It is possible. Why do I say that? Number one is because the cycle is upon us. So we're going to get large swings in both directions. So I won't necessarily be surprised even if we get some kind of retracement tomorrow. But what's going to happen overnight is we're going to have Asia markets open and they're going to get hit pretty hard. And then tomorrow morning, we're going to have the European markets and they're going to get hit pretty hard. You're going to have the emerging markets around the world. They're going to get hit pretty hard. So that could become another down day for our markets tomorrow as a follow-through day. And that would be, I'm going to say, more likely than not. Let's just look at another market. We look at the Philadelphia Semiconductor Index. We look at this from time to time. This got hit pretty hard, and you can see we've talked about this a number of times, at least half a dozen times. This top was put in, and we never challenged that high. This was a market telling us it was rolling over, right? It was telling us that there was trouble out there. It was not confirming the move in the Spider or the S&P 500 or the Dow, which was at 22,000 just a couple of days ago. Now we're at 21.8 and change. This is the beginning, folks. This is not a one-day wonder, in my opinion. Let's flip over to gold. Gold is rallying. Gold is heading toward 1,300. I'm not 100% sure they get there. They should get there. It should act like a magnet. They may even get up to 1307, but you're going to have some other areas that are important. You have a gap window here that comes in at about 1295 and change, I believe. Let's take a look. The opening price, 1295 spot 70. So 1295, 1296, you're going to have some resistance to the market. Generally, when price trades up into, this is a gap window, and I'll draw it in. When price trades up into a gap window, okay, you will likely get a price reaction in the other direction. Here's a gap fill, okay, right here. This is right at like 1299, 1300. So in this neighborhood is where my expectation is, where we should get a pullback in the gold market. If I see gold above 1,300 at or above $1,300 a share, per ounce, I am shorting the gold market. Looking over at silver, silver was up more than gold today, up almost 1.5%, came into the 200 period moving average. We talked about this. It was a fake out with this big down day. And then when we started going higher and silver was acting better than gold, and we had that big up day yesterday, it was pretty obvious they were going for the 200 period moving average. And like the gold chart, and I didn't draw it out for you, but it's the same deal. This is an A, B, C corrective pattern. So that ABC corrective pattern is now officially complete from a technical perspective. However, we could still go higher. There's nothing that says we can't. An interesting level for silver is actually at about 1740, give or take. Maybe it's 1737, maybe it's 1742, but that's an interesting area that if we spike up into that area, that should provide a pullback. It should provide daily chart resistance for silver. And there's a number of reasons why. A, it's a 618 retracement. B, you have a lot of pivots. You have a pivot here, you have some pivots up here, you have pivots over here. Yeah, I mean, just there's a lot of different reasons why that level should be resistant to the silver market. Crude got thumped, and we talked about crude down at $48 a barrel. Our low today was $48.35, but we talked about this in two veins. The first one was, on a short-term basis, we had a bearish pattern. Well, this played out, all right? So 48.35 against 48, that's complete as far as I'm concerned. So that played out. We could certainly go lower, but as far as this pattern is concerned, that's done. That's over. Doesn't mean we can't go lower, but the pattern is over. But then the second thing that precluded us from taking a trade is that we had an up move and we're going sideways, and this could easily still, yet today, promote another move higher. There's nothing that says that this still can't be a bullish pattern from a longer term perspective. Short term, this was bearish. Longer term, it's still above the 50 and 20 period moving average. We're still technically, from a daily chart perspective, in an uptrend, so there's nothing that says we can't go higher. We're consolidating below the 200 period moving average, okay? So if we were to go higher, the 200 period moving average wouldn't necessarily provide the type of resistance that one might think. We would most likely get up to and above the 52 area where these pivots are up here. And that's what my next target would be if we turned around and started trading higher in crude oil. Again, with all the geopolitical stuff going on, it's not out of the question that Iran steps in or Russia steps in somewhere and all of a sudden they start talking about energy and they start talking about crude oil, and the next scene shows crude oil is up $2 or $3. It happens over and over again, and it's not out of the question. I'm not suggesting that's the reason why. I'm suggesting the reason would be a bullish pattern off the up move that we made right here. So we have an up move, okay? We have sideways consolidation. If we remain above the moving averages, this is a bullish pattern that likely will go higher, but the news will pin it to something else. That's fine. No harm, no foul. Now, today we had an update in the bond market, and it's really not a surprise. You would expect, and it's not that I'm marrying the markets together. You know I don't like to do that. I don't like to correlate markets, okay? However, when the stock market gets hit pretty hard, it's not unlikely, and we talk about this all the time, that money rushes into the treasury market. When the day comes where they're both selling off together, that's an ugly time. You don't want to be around in either of those markets on the long side when that's happening. But it's not uncommon, not unlikely, and not unexpected for the bond market to rally a little bit in the face of a declining stock market to the likes of which we saw today. It'll be interesting to see if they can get above the upsloping trend line that's contained the bond market for all this time. We only were able to close above this trend line one time. I think it's about 25 or 26 trading sessions. We were only able to close above it one time. I could even be off by a few. Whatever it is, it's a long time. And so we'll see if they're able to do that. Either way, right now, I'm not interested in shorting the bond market even at that line, okay? Because certainly if we're selling in the stock market, we could pose a rally and we could see a rally in the bond market. It's not out of the question. I don't feel comfortable. It's not a comfortable or high probability short right here, right now. I'm not saying it can't go down. I'm saying I'm not interested in shorting the bond market right here, right now. It's not on the table for me. And the dollar, we just continue going sideways in the dollar. They tried to rally it again into the 20 period moving average, but all in all, it's another sideways day. This is a bullish consolidation pattern. If you take it from this up move here, okay, and then we've just been going sideways, that will generally promote another move higher. It's just a matter of time. The more time that passes by, the more time that goes by where we go sideways, the more likely we are that the market's going to take another leg higher. Nothing's changed in the dollar. And with that, I'm going to wrap it here tonight. May we live in interesting times. We'll see what tomorrow brings. I'm David Frost. My strategic forecast, Thanks for tuning in for another episode of Common Sense Market Analysis.